Most investors are making the same mistake. They're looking at the wrong data when they choose suburbs. They're chasing whatever grew last year, or they're following generic top 10 lists everyone shares on social media. It's costing them hundreds of thousands in missed opportunities. I've personally researched thousands of suburbs, and I can tell you, there's a specific framework that separates the professionals from everyone else. And that's exactly what I'm going to walk you through today. So in this video, you're going to learn 3 things. First, I'll show you the infrastructure signals that predict growth 2 to 3 years before prices actually move. These are publicly available, but almost nobody knows where to look. Second, you'll learn the real supply-demand equation that tells you if a suburb is about to squeeze, because just looking at vacancy rates doesn't tell you the whole story. And third, I'm going to show you the street-level signals that tell you a suburb's about to transform, way before it shows up in the data. Let me tell you why this matters so much. I work with property investors who are building serious long-term portfolios. People who know that one bad decision can set them back years. Here's a scenario I see play out repeatedly. An investor finds a suburb that looks perfect on paper. Recent growth, decent yields, close to the city, all the boxes ticked. But when you dig deeper into council data, you discover 3,000 new apartments are about to hit the market in the next 18 months. What happens next? That suburb's rental market gets flooded with supply, and vacancies spike and rents drop. This taught me something crucial. Surface level research doesn't cut it. You need to know exactly where to look, what predicts growth, and how to separate genuine opportunity from hype. That's the difference between strategic investment and an expensive mistake. Let's talk about infrastructure and employment. The first method is how I identify suburbs 2 to 3 years before the market catches on. If you can spot infrastructure investment early, you're getting a preview of where the property values are heading, and it's completely legal insider information. What you're looking for is government-funded infrastructure combined with employment hub expansion, and not just any infrastructure. I'm talking about major transport links, new employment centres, and significant public investment. Step 1. Access government planning portals where most people don't know where to look. Visit your state's planning portal. Some examples are New South Wales Planning Portal, Victorian Planning Maps, or Queensland PD Online. Check Infrastructure Australia's pipeline reports and review your local council's strategic plans and development applications. Step 2 is to identify game-changing projects. What you're hunting for is new or extended rail lines, light rail or major highway upgrades, new hospitals, universities, or major employment precincts. Look for projects with confirmed funding and realistic timelines, ideally 2 to 5 years out. Step 3 is to map the ripple effect. The key is not to buy right at the station. Look at suburbs within 5 to 10 kilometers that suddenly become accessible. Where could young professionals now feasibly commute from? Which suburbs were previously overlooked just because of poor transport? So let's look at an example. Take Brisbane's Cross River Rail. When that was announced with confirmed funding, smart investors didn't pile into properties right at the new stations. They looked at the outer suburbs that would suddenly have 30-minute commutes to the CBD. As the market gradually priced in that improved connectivity, those areas saw serious growth. The best part is you can find that information completely free on government websites before most people start paying attention. Now, infrastructure tells you where growth could happen, but this next indicator, this tells you if it's actually going to happen. Because you can have all the infrastructure in the world, but if supply and demand are out of balance, you're in trouble. Point 2. Supply-demand equation. This is where most investors make critical mistakes. They see low vacancy rates and think they found a great opportunity, but they haven't looked at what's coming down the pipeline. Understanding the supply side is what separates a smart investment from a value trap. You need to analyze 3 metrics together: current vacancy rates, the development pipeline, and the rental demand trends. All 3, not just one in isolation. Step 1. Check current vacancy rates. Use SKM Research. It's free to check suburb vacancy rates. Look for anything under 2% as your starting point. But don't stop there. This is just the beginning. Step 2 is to research the development pipeline. This is critical. Check your local council's development applications and approvals. Find out how many dwellings are approved or under construction. Compare that to the current housing stock. For example, if 1,000 new units are coming to a suburb that only has 3,000 existing dwellings, that's a 33% supply increase. That should set off alarm bells. Step 3 is to analyze rental trends over time. Look at 12-month rental growth trends on Domain or CoreLogic. Check if properties are leasing quickly. Days on market tells you a lot. Confirm if vacancies are rising or falling over a month. So what are you looking for? The ideal scenario is this: vacancy rates under 2% and falling, rental growth above 5% annually, and manageable new supply that actually matches population growth. That's a suburb with genuine demand, not just a temporary squeeze that's about to reverse. So some of the warning signs: if you see tight vacancies, like 2,000 apartments completing next year in a suburb with only 5,000 dwellings, that's a red flag. The market's about to flood. This is exactly what happened in parts of Melbourne and Brisbane CBD between 2016 and 2018. Investors who only looked at vacancy rates were significantly impacted. So now you know how to validate demand with hard data. But here's what most investors never even consider. Some of the best opportunities don't show up in spreadsheets yet. They show up when you're walking the streets. Point 3. Gentrification signals. This is how you find suburbs before they're on anyone else's radar, before the data reflects it, before the median price jumps. You're spotting the transformation in real time. Gentrification leaves physical footprints, and if you know what to look for, you can identify emerging suburbs 2 to 5 years before they are officially hot. So step 1 is to look for lifestyle upgrades. Watch for new artisan cafes, craft breweries, organic grocers, or boutique restaurants. Other items to look out for is co-working spaces, art galleries, creative venues that are opening up. These signal that higher income residents are moving into the area. Step 2 is to observe council investment. New parks, bike lanes, streetscaping, public art, upgraded playgrounds, community centres, and beautification projects. Council only invests where they see real momentum. Step 3 is to check the demographics. Are new schools being built or expanded? Is crime trending down? You can check local police stats for this. Are you seeing young professionals or families replacing the older demographic? Step 4. Visit in person. Visiting the area is essential. Walk the main street on a Saturday morning. How busy are the new cafes? Are they packed with 30 or 40-year-olds? Is there construction happening? Modern townhouses? Renovated homes? Some real examples. Consider Dandenong in Victoria. There's been a significant $2 billion urban renewal project happening there. Early signs included new cafes, street art spaces, boutique stores opening up. Investors who recognize that transformation early have benefited as young families and professionals discover the suburb. Or take Marrickville in Sydney's inner west. It has experienced dramatic gentrification with an explosion of hip eateries and creative industries over the past decade. Property values have responded accordingly. So the key? You want to catch the wave early, not after the suburb is already on everyone's hot list. By the time it's mainstream, much of the growth opportunity has already been captured. Now you know how to find the suburb, but here's where most investors make a critical error. They choose the wrong property type in the right suburb. Let me show you how to match your property to your goals. Point 4. Property type strategy. This is where it gets personal, because you can find the perfect suburb, but if you buy the wrong property type for your goals, you're either leaving money on the table or setting yourself up for cash flow challenges you can't sustain. Different property types serve completely different strategies. Houses maximize capital growth. If you need cash flow, that's where commercial property comes in. Your choice depends entirely on what you're trying to achieve. If your goal is capital growth, building long-term wealth, look at freestanding houses. Why? Land appreciates and structures depreciate. Houses have more land, which means stronger growth. Historically, houses have delivered the strongest capital growth in Australia, often outperforming units by significant margins over time. The trade-off? Lower rental yields, usually around 3 to 4% mark in most markets. They cost more to buy and hold, maintenance is all on you, and the cash flow might be tight or even negative in high-end areas. But the strong growth can exponentially increase your wealth, which can leverage more investments down the track. If your goal is cash flow or immediate income, consider commercial property. Why? Commercial properties typically offer significantly higher rental yields than residential, often 6 to 8% on a net lease, or more, depending on the property and the location. Longer lease terms provide stability, and tenants often cover outgoings like rates, insurance, and maintenance. Commercial property operates differently from residential. You're dealing with business tenants. Lease structures are more complex, and location factors change. You're looking for foot traffic, business districts, and economic activity rather than school zones and lifestyle amenities. The trade-off? Higher entry costs, more specialized knowledge required, and different financing structures. Capital growth can be strong, but it's typically tied to the income of the property, rather than the land value alone. Commercial property also carries different risks. Vacancies can be longer, and economic downturns can impact tenant businesses. A well-located house in a growth suburb with strong fundamentals will give you capital appreciation over time. While the yield might be lower initially, the equity you build becomes the foundation for expanding your portfolio. Whether that's more houses or eventually moving into commercial once you have the scale and experience. So what's the strategy? Professional investors build their portfolio strategically. Start with residential houses in high-growth suburbs to build equity. Once you have substantial equity and experience, consider adding commercial property for cash flow. The key is matching each property type to where you are in your investment journey and what your portfolio needs. So, a critical reminder: match the property type to what works in that market. For residential, look at what local renters want in the suburb. In a city, units may dominate rentals. Suburban family areas, houses lease faster to longer-term tenants. For commercial, you're analyzing business activity, tenant mix, and economic drivers. These are fundamentally different investment approaches. Before we wrap up, I need to warn you about the single biggest mistake I see investors make when they're researching suburbs, and it's costing them significant returns. They look at historical growth alone and base their entire decision on that single data point. They see a suburb that grew 15% last year and think, perfect, that's my winner. This is completely backwards thinking, and here's why. Historical growth tells you what already happened. It doesn't tell you what's coming next. In fact, suburbs that just had massive growth often go through consolidation periods where prices flatten out or even correct. You're buying after a significant run-up. Think about it logically. If a suburb just had exceptional growth, one or two things is probably true. Either that growth was driven by a specific catalyst that's now exhausted, maybe infrastructure that's now complete, or development boom that's finished, or the market has already priced in most of the future potential, and there's limited upside remaining in the near term. Consider this example. Through 2021, many regional Queensland suburbs saw extraordinary growth from COVID migration boom. Some areas jumped 20 to 30%. Investors who looked at that historical data in late 2022 and bought thinking it would continue were disappointed when those markets cooled significantly in 2023 as conditions normalized. They were looking in the rearview mirror instead of through the windshield. So what should you do instead? Instead of chasing last year's winners, use the framework I just shared with you. Look for infrastructure that's coming, not infrastructure that's already there. Identify supply-demand imbalances before they tighten, not after. Spot gentrification in its early stages, not when it's already mainstream. Historical growth can be one data point in your analysis. It shows the suburb has fundamentals that can drive appreciation, but it should never be your main decision factor. You want to identify where growth is going to happen next, not where it's already happened. So what's the key takeaway? Smart investors are forward-looking. They're reading the signals that predict future growth, not rewarding past performance. That's the difference between strategic investing and just speculating. Everything I've shared today gives you the framework to analyze suburbs like a professional. But the reality is, doing this level of research for every potential investment takes significant time and expertise. If you're a property investor who wants expert guidance to build a long-term strategic portfolio without the years of trial and error, I invite you to book a free consultation with me, and you can do that using the link below. If you found this valuable, hit the subscribe button. I put out new property investment content every week for investors who want to build wealth efficiently. I'm Carl. Thanks for watching, and I'll see you in the next one.